just give us another minute. We're going live, so we just need to coordinate this with the folks back in the studio.
Hello and welcome. The big moment has arrived and we welcome all of you to election 2014, the road ahead. Well, someone asked us before we attended the stage, do you have gatherings like this very often? And we said, no, they're pretty rare. And I can tell you this looks like a one-in-a-generation kind of event. That's the kind of mandate that we have got in the just completed polls. For the first time in 30 years, one single party has got an absolute majority, and more importantly, put together with the Rajya Sabha, along with the NDA's support, this party can pretty much pass any legislation. It's a 51% when the two houses sit together, if you consider the NDA's seats in Rajya Sabha as well. Second, this is the first time ever that we have someone who has proven his administrative and developmental record at the state for 10 years come and become the Prime Minister. That's pretty much the first for this country. And thirdly, this is probably the first time since probably, again, 1984, since the past 30 years, that one person has got the mandate pretty much on his own and is not even beholden to heavyweights within his own party. Now that pretty much changes the political economic setup, doesn't it, Shireen?
Absolutely, Lata, and thank you very much for setting the context of this evening. Thank you very much, ladies and gentlemen, for joining us here at this special CNBC TV 18 post-election panel discussion. We've got with us some of the most influential voices who can take us through what they feel is likely to happen as far as the economy is concerned, as far as the mood in the market is concerned, and with key crucial reforms. Without further ado, let me introduce our esteemed panelists here to you tonight. Arundhati Bhattacharya, the chairperson of State Bank of India, Aditya Narayan of Citi, Sajid Chinoy, the chief economist at JP Morgan, Vikram Mehta, the former chairman of Shell, now with the Brookings Institute, sits on the boards of companies like L&T and Mahindra & Mahindra. In a short while from now, we'll be joined by Madhu Kela. We are also going to give all of you, ladies and gentlemen, an opportunity to interact with our panelists here. I'd request you to keep your questions short, and we will get to you in just a few minutes from now. My first question to you, Arundhati Bhattacharya, there's so much hope in the air at this point in time. Expectations are running high that Mr. Modi is going to storm Delhi, that he is going to wave this wand, and the economy is going to, from sputtering, is going to start revving up. In terms of executive action, forget legislative action for a minute. In terms of executive action and executive decisions, what would you like to see in the short, immediate term for us to be able to say, all right, we have the context now for the growth engines to be kick-started?
First of all, let me tell you one of the major things that has happened and which you all have also underlined is the boost to confidence. I think a positive sentiment is absolutely essential for any industry or any economy to perform. So that, I think, has already been achieved.
So just the fact that we have this kind of a mandate, you think that is a confidence booster enough?
Absolutely. It's a huge, huge confidence booster. You've been seeing the way the markets are reacting. And why I believe the markets are very important, as you know, especially for banks. There has been a lot of talk about over-leveraging by corporates. One of the reasons for over-leveraging by corporates is their inability to raise capital. Now, the inability to raise capital stemmed from the fact that the sentiments were negative. And now that the sentiment has turned positive, this will definitely enable a lot of our corporate borrowers to go to the market and raise the necessary capital that they in any case had planned to raise, but which they had put on hold because the valuations were just not available. So that is going to be a major booster for the economy, for the quality of our asset book. So overall, I believe this is something that we are really looking forward to. But you talked about executive action. One of the things, in fact, I think one of the other bankers has also said in the first reaction to the elections was the fact that we really wish that, the bills that are held up and not paid on account of various reasons, various disputes, that there is a dispute resolution mechanism that the government puts in place very quickly to enable these bills to get paid. And these bills could be with the central government, with the state government, with many of the PSUs. But this will definitely help because many of the major projects that are being undertaken at this point of time, if the bills don't get paid on time, then the subcontractors and the people below that and the suppliers, they all get impacted. The whole chain gets impacted. And the entire working capital cycle starts getting extended and the stress comes in. So once these bills start getting paid regularly, you will find the stress getting released in the system, getting reduced in the system. So payment of bills, and if it is necessary, then to have an arbitrating mechanism to get it done as quickly as possible, and not to have to go to the High Court for every single bill in order to get it paid. That's one. The second thing that they can also possibly look at is, in many of the projects, while CCI has cleared them and while they have started moving, many of these projects have several agencies which are required to coordinate and collaborate. For instance, in a road project, it is not only the Highway Ministry or the National Highway Authority, it is also the state government, it is also the railways, because they have to lift up the bridges or the railway lines. So there are several agencies involved in every project. Now, every project, if it can have a small working group to ensure that all of them give the whatever is stuck up at one point of time, instead of having to pursue with the several agencies, this also will speed up project execution, and whatever is still held up, that will get released very quickly. So in very short order, actually a lot of things can happen. If these two things, these are very simple things, these are on the table, if these two things start happening.
Arundhati, short points. Can you say that in terms of quantum of NPLs, the worst is over, that incrementally we will add less than we added in the fourth quarter? At least that can you say for the system?
No, I cannot say that for the system. My own results are coming in the middle of the week, so
Which is why we didn't ask you for your banking specific.
That is why I'll not say that. But I'll go back to what I said even in the last quarter. I had said, give us 2 quarters after the GDP turns. I stick by that. You should give the banking system 2 quarters after the GDP turns. Because again, as I said, it takes time for the whole thing to sort of, get into the system and work through the system. It has to flow through various agencies. It has to flow through various layers. And which is why I'm saying, the shortening of the working capital cycle, the opening up of the capital markets, 2 very, very important parameters to get the stress down in the system. If both of these happen, surely you should be seeing the results of it 2 quarters down the line.
Okay. Aditya, just taking it from what Arundhati just said, 2 quarters after GDP turns, what's your sense? When does GDP turn itself? I mean, the stock markets, as is very obvious, discounts a bright future at least 9 months, 12 months before it actually happens. So when is the turnaround quarter for corporates?
In many senses, as far as GDP growth is concerned, I think we're really looking at this year itself, where GDP gets off the 4.8% low that you hit in the previous year. I think the acceleration, this is more normalization that happens from 4.8 to 5.5 or wherever people are. I think the potential acceleration, particularly on the back of the fact that there is improved sentiment, as ma'am just said, and there is a certain bottoming that you're close to seeing in the economic cycle itself. I suspect it's when you start seeing that acceleration into the next year, FY16. I think that is when you're going to get more confidence in the system, and you will be able to back up some of the bets that the market is beginning to take at this point in time, because there are, clearly the market is extrapolating some kind of a reversal, and that needs to be, FY16 is going to be a challenging year, because while everyone is anticipating a recovery in that year, it also needs to come because that risk is being built in.
Rajesh, I know your last report said that the GDP forecast for the current year is 5.3. Do you have any bets that you may be revising it by the time you come to the second half or the fourth quarter?
Lata, I think there's a lot of excitement in the last 72 hours, but we have to view this not as a T20 match, this is a test match. And it's the first morning of a long test match, and if I could extend the analogy, it's a pretty bouncy and green wicket. So I think we should worry about what GDP is 2 quarters from here, and forget worrying about the output, worry about the input. And here I'll make 2 very quick points. I think this kind of mandate, for the first time in a generation, creates the possibility of big, bold, strategic reforms. Not now, not next quarter, 3 years from now. The distribution part of the power sector, coal denationalization, labor market reforms, the kind you couldn't have imagined 10 years ago. But in the near term, there has to be tactical things we have to do. No one's spoken about food inflation yet. Without food inflation coming down, very hard to see the monetary policy cycle turning. There are things the government can do working with state governments, the APMC Act, MSPs, I think talking about changing the mix in the first budget towards public investment away from subsidies, recapitalization of public sector banks. Those are the tactical things that you can do now to help GDP 3 or 4 quarters down the line. I would worry less about what GDP is and focus more on what these inputs are this year and the next.
Madhukela, let me ask you, because Sajid used the T20 analogy, and the markets are, working with that analogy, at least at this particular point in time. Where do you see the markets headed in the short term, and do you believe that the next big trigger in that sense is going to be the budget?
Yeah, I think the formation of the cabinet is what we are looking at, the first trigger, because what kind of team Mr. Modi creates.
Will that really impact sentiment? For instance, if there isn't Arun Jaitley or Arun Shourie in the finance ministry, is that going to dampen investor sentiment?
No, I think the overall team is what we are talking about, and since it is few days away, let's not speculate on that, but I think the overall team, and as he repeatedly said, that execution will be done by the team. I am the guiding force, and he has said it in interviews so many times that I have all the time in the world. So we are hoping that what kind of team gets created, that will be the first signal market will wait. The second, of course, will be the budget. So the point which ma'am was making, I would just like to say that, stock markets are so well linked to sentiment that feel good has come. And that is very, very important, that the kind of scare which was there in the system, that whatever you want to do, if you do this, this will happen, that will happen. So that whole scare has gone away. And start of any economic recovery or building of corporates only starts with people's ability to take money from the markets. But that really frees you up. You see, if you are a very leveraged company, the moment you get even 5% equity or 10% equity compared to the debt, it creates a very spiraling good environment for that corporate. And I see that has happened.
Do you agree with Ms. Bhattacharya that we are at that point now?
We are already there, ma'am. Most of the companies, the stress companies, market cap has gone up by 100 to 300% in last 6 months. We are not looking at 3 days. Market has been talking about this factor for last 4 or 5 months. You look at all old economy stocks, a lot of them have gone up between 100 to 300%.
Yeah. Before I come to Mr. Mehta on exactly what India Inc. will look for in the budget, let me just complete this point with both Madhu and Aditya raising about stock market sentiment, and Arundhati as well. The sentiment does, probably started on December 4th when the 4 state assembly elections gave us the writing on the wall. But Aditya, the economy is in a tangled mess. And the first budget for the first 9 months really can't do much. It will in all probability give you the bad news that the fiscal deficit is going to be 4.5 or 4.6. Let me get to more, kind of distasteful analogies. When the NDA 1 came to power, it took them a full 5 years. The best year of growth was their last year in office. Ronald Reagan, another era to which this present tenure is compared. 1980, November 20th, he's sworn in. 1981, the US markets, the DTIA, was minus 10% at the end of the year. It took 3 years of recession and rising unemployment before things started kicking off. So, is it possible that the market will be in a euphoria up until the budget, maybe a little longer, but thereafter have to lick its wounds because the wounds are so deep?
In many senses, the 3 years of near recession that you faced over the last 3 years, that I think tends to... Yes, we've done a fair amount of it. Quite honestly, I think there probably still is another 2 to 4 quarters that could well get extended. But I think the big bit is, and I think that's where you tie in with the economic cycle, that you've been slow for the last 3 years. And there are 2 parts to it. One is the economy refixing itself. But I think equally importantly, if not more importantly, it's corporates who have refixed themselves also. They might not be out of the woods, but whether it is deleveraging, whether it is looking at costs, whether it is conserving cash, a lot has actually been done. So in many senses, the sweet spot of the market is really not just the political angle, or you can argue the macro angle. The reality is you're also in an incipient economic cycle where you're close to the bottom. So the question you raised on whether the budget could be a dampener because expectations have gone up, I think if 12 months down the line nothing happens, that's going to be a problem, not a couple of months or a couple of quarters. I think there is a lot of willingness in the market to wait through till the end of this year in any case, post which then people will start asking questions.
Okay, to you, Mr. Mehta, what do you think India Inc. wants to hear in the budget itself? Is there something that can make you all reach out to your purse and put in, announce capex plans in whatever sector? Perhaps not in power, where perhaps we are flooded with a lot of power.
Or not in oil and gas either.
Why not?
But do you think people will
sector
reach
that
out? You're familiar with?
I think the fact is that there are severe structural issues still to be contended with in this economy. We have a financial problem, and the government will have to consolidate the fisc. And the budget will have to look at ways in which they can cut expenditure, whether it's by reducing subsidies, whether it's by cutting back on some of the wasteful expenses that have been incurred. So that is, I think, one very important signal that India Inc. will look at. Are we able to actually contain the fiscal deficit? I think the second thing that India Inc. certainly would look for is, will there be a signal to the Reserve Bank, for example, with regard to the monetary policy? Now, there is this sort of tussle between inflation and growth, and there's no doubt that we cannot have high growth or sustained high growth if we are living in a high inflation environment. At the same time, there are severe supply-side issues that have to be tackled, and the question is whether or not inflation can only be addressed through the monetary instrument, or whether we should actually look at a combination of monetary, fiscal, and supply-side sort of instruments to tackle inflation and revive growth and also create jobs. So that third thing, I think, which India Inc. will be looking for, what is going to be done to actually encourage not just the manufacturing sector, but also micro, small, and medium-scale enterprises. And the reason I say that is because this is what's required in order to create the jobs that have to be created to absorb the new entrants into the labor market. So manufacturing sector is important, but that's not going to be the only sector that will that can create jobs. So I think India Inc. will also be looking at that. So ultimately, and then finally, I think there is the issue that everyone's talked about, which is business confidence. Is there going to be an affirmation that contracts will be respected, that there won't be any arbitrary tax sort of charge against investors, that once the playing field will be level? And of course, this whole idea that there is this crony capitalism culture that was created over the last 3 years, will that be contained? Because I do think that's some of the issues that have to come out in the budget.
Mehta, I don't think in the budget he'll be able to give too many signs on that. But let me just take
I think he can. I think all of that can be done. It doesn't have to be done in the language that I've just used. But I think there are messages that are contained in the spirit of the budget, which will then get translated into the letter of interpretation.
Well, just a minor point of view, which perhaps would be agreed or disagreed with by the panel. You said a signal to the Reserve Bank. You want the government to tell the Reserve Bank to cut rates?
No, exactly. I'm not for one moment suggesting that the government of India should actually abridge the autonomy of the Reserve Bank, okay? I do think, however, there is got to be, you asked me what the question was, what does India Inc. want, okay?
Yeah.
All right, so I was responding to that. And I'm just saying that India Inc. would like the central government to at least address the issue of growth in a very frontal manner. And the issue of growth is not going to be addressed unless and until there is some sort of idea on how you're going to treat the cost of capital. That's what I'm trying to say.
Can the cost of capital come down? Short point, will the Reserve Bank, no matter what the government does, unless it brings the fiscal deficit down to 4.1, is there space?
Mehta, you spoke about the Reagan-Volcker analogy, remember that? And I think one of the key points there was Reagan backed Volcker to the hilt. And that's how the US finally came out of stagflation. The point is, if you look at the emerging market history over the last 30 years, very few, if any, emerging markets can grow in the medium term unless you bring inflation down. Now, this has to be a combination of both fiscal and monetary policy. I think the central bank should stick to its course, which is to bring headline CPI down in a disinflationary path. There are fiscal things that can complement that to be done. But if you're going to be living with high inflation a year from now, if it's 9, 10, 11%, if inflationary expectations 1 year ahead are 10, 11%, that can never be a good macroeconomic environment for private investment. So I think the simple reality is over the next 2 years, things may take a little longer for the simple fact that the classical counter-cyclical policy response, which is looser fiscal policy, looser monetary policy, will not be available.
Yeah.
We'll have to tighten the fist, keep monetary policy tight. What you need to do instead of moving the demand curve is move out the supply curve. And that has to happen entirely through industrial policy and all the things that we've discussed so far.
So Aditya, Madhu, just to wrap up the comment as far as interest rates and what could possibly happen on the 2nd of June is concerned, have the markets factored in the possibility of a status quo policy, or are markets expecting that we will actually get some relief given the inflation context?
See, to be honest with you, my personal opinion is market is not really looking at a steep cut in the interest rate in any way, in any immediate immediate
will they
future.
be okay with the status quo policy till the next budget? Because the RBI's goal is 8% CPI by Jan 2015. So pretty much up until Jan, they are not looking, they seem to be hinting at no change.
I would say the RBI may itself change its mind if they think the government actions and their intent are in the right direction. See, that is how things stand today.
Fair enough. No, fair point. But if it doesn't be, do you think the markets will lose? If you're going to continue to see a repo at 8% as of Jan 2015, will that be a dampener? Isn't that your question?
Yeah.
Again, to my mind, that there are three levers. One lever was, as Sajid was saying, that the overall demand environment becomes positive and there is a growth. And the third lever was equity. Interest rate is in between. I think corporate world can live with 50 basis point interest rate here and there. The worst part was there was no capital available. Forget the interest rate.
Yeah.
If the overall environment becomes positive, you start tapping the equity markets and that money is available at a cost, then we can live with 50 basis point higher for the next 1 year.
Aditya, you...
A couple of things. Most of them actually support what Madhu said. The first thing is I don't think the markets are so defined in their expectations. So I think whether they're expecting 25 down or 25 up, I don't think it's so defined. Secondly, Madhu's point I think is very relevant. I think you have to look at the overall cost of capital. There's too much of a fixation on the cost of debt. Particularly given the delta you've seen. Ma'am talked about rising confidence, capital being available. I think the overall cost of capital has actually already come down. If this market holds, it has already come down. And I'd say it's not an unfair level in terms of the cost of capital. I think 6 months back when interest rates were high and equity valuations were low, you had a problem with the cost of capital. Today, I don't think that is the case. And in fact, if there's a delta in the recent move for businesses, it's the cost of capital that's actually normalized a bit.
Lata, just one small point. In my experience of last 20 years, I have seen the markets don't get excited by 25 basis cut or 25 basis hike. They're excited by the trend line. Is the interest rate going up by 200 basis points or are they going to come down by 200 basis points?
That is because it impacts sentiment.
Exactly.
Go back to the same thing, it is the confidence level and the sentiment. That is what is indicated by a hike up or a cut. So I think that's absolutely right. It's not the quantum.
Okay. We were talking about monetary policy action and what the Reserve Bank may or may not do. Let me talk about fiscal measures, and let me start by asking you, Sajid. There's been so much talk about subsidies, fiscal profligacy, moving back to the path of fiscal prudence. Do you believe that in terms of curtailing subsidies, in terms of actually pruning the kind of expenditure we saw under the UPA as far as flagship schemes are concerned, the NREGS and so on and so forth, we are going to see decisive action towards that? Or is it going to be, for the lack of a better word, benign neglect? So you leave things as is, and then deal with them at a later date. What is your anticipation there?
Well, the hope there will be something decisive, but not in the first budget, in the first couple of budgets. Remember, our consolidated fiscal deficit today, including contingent liabilities, it's 8% of GDP, centre, states, SEBs. You can't run any modern economy with that kind of fiscal deficit. Now, the first budget actually poses many more challenges than are actually apparent. You have to achieve 0.5% of GDP or thereabouts fiscal consolidation. You have very weak growth and therefore very weak tax revenues. You want to have higher public investment to create all these corridors and jumpstart the capex cycle. You need more funds for bank recapitalization. So how do you square the math? If you've got low tax revenues, higher public investment, more bank recap, and you have to achieve fiscal consolidation, one of two things has to give. Either you credibly have an aggressive path for disinvestment, non-tax revenues, either auctioning of resources or disinvesting public sector enterprises, or you begin to scale down subsidies more dramatically. If you do not do either of those, the budget assumptions, I'm afraid, will not be credible. So one of those two, they'll have to bite the bullet in one of those two. I think we should be realistic given the political economy. Don't expect dramatic reduction of subsidies in the first budget. I expect it will be holding things similar in nominal terms so that in real terms they begin to drift down. Give the new government some time. It will take a couple of budgets to reorient the nature of spending from subsidies towards greater capital investment.
Madhu, you're smiling.
Sarin, I think you are jumping the gun. To my mind, the next 45 days are more important than the first week of July.
Okay.
That, in the next 45 days is when you will lay the foundation of confidence building. If they are able to successfully do that, then even
what do you want them to do in the next 45 days?
I'm saying formation of government, formation of a very good cabinet which gives confidence to investors. Secondly, really selling the India story as the Gujarati story was being sold. There is trillions of dollars of liquidity which is there. Notes have been printed, dollars have been printed. That is looking for a home.
But the talking already happened, right? Now people will want to see all of that.
No, that's right, but that money can come and change the whole economics. I'm saying incremental basis, whether the fiscal deficit is 4.6 or 4.5 or 4.7, that is again not going to move the market. What I'm saying is, if you create confidence, and if you are able to attract FDI money, if you are able to attract direct money, and if you are able to open up equity markets, that is what the market...
But will it? I mean, let me get Aditya also on that. It's, no matter how you do the fiscal math, I'm not getting a number below 4.5 until, unless my assumptions are terribly wrong. Tax buoyancy will come only if there is growth. And people like Sajid say they're not going to increase their growth forecast this year itself. I don't know if you're earning.
For a start, I'm not an economist, but I would take a slightly different tack. I think the one pressure this government will face is starting to generate jobs, because that's been its political campaign right through. And, my own sense is a little bit of spend, secondly, a little bit of redirection as far as subsidies are concerned is not such a bad thing. You need fiscal consolidation at the end of 5 years and over a period of 5 years. I think you run the risk of slowing down the economy too much so that the recovery gets harder. If you keep clamping down, as Ma'am was talking about the NPA cycle, payments are not being made. That is hurting the system. So I think you need to loosen up a little bit actually, and maybe some directed spend. So I would actually argue the quality of the fiscal deficit clearly needs to improve. Exactly. I don't think there should be such an emphasis
on the number.
On getting it down.
That might still mean 9% inflation 1 year down the line if you continue to have 4.7, because that is the math. You have to, bridge that gap with printing notes, and that will mean everything becomes a little more expensive. You have to live with 9% for a year more.
I mean, again, I'm not an economist, but I think there is a cycle to it. You've had inflation for quite a bit of time. I think with demand having come off the way it has, I don't think there is any demand pull inflation in the system, which is meaningful.
Yeah, actually speaking, what he's saying about the redirection of the spend, I think that is very important. How is the spend happening and where is it happening? And not only that, for instance, you take the Narega. The Narega is supposed to have put in a lot of money into the countryside. But if you look at Gujarat, one of the reasons why they have had such excellent growth in the productivity of the agriculture sector is because that they were very successful in creating rural infrastructure. Now, if the same thing is replicated across the nation, the Narega spend is already happening. But if you add that to responsible creation of good rural infrastructure, the productivity will rise, the amount of wastage that is there, that will go down, and as these supplies become better, your supply side will work towards bringing down your inflation.
Mr. Modi spoke about it several times. It didn't find its way into the BJP though when it talked about Narega, but they publicly he stated that is the road that they would like to take.
This is very important because again, if you're looking at inflation, it is food items that is really driving the CPI. And if you can get in that agricultural productivity, not only the productivity on the ground, but the infrastructure to get it out and into the markets in time, and at the time that it is required, and even to predict what is required, so that if necessary, imports and exports can be accordingly, timed. You will find that this will definitely have a beneficial impact on the CPI.
So there's no taking away from the fact that...
Go ahead. I think what market is actually liking it and admiring, because there is an empirical evidence of this man having delivered all of it, which we are worried about. So they have delivered a 10% growth in agriculture production over the last 10 years. They have delivered a over 10% GDP growth rate for last 10 years. And go back to Gujarat in 2002 when they took over. I think the problems were even much stronger than what we are talking about. So that is what I think market is thinking, and it is willing to give.
There is a serial miracle in Gujarat, and to some extent it got triggered because ultimately the Narmada Dam got built and the trickling effect came. But that certainly was not the only reason. I take your point that the administrative bandwidth in Gujarat was used to, to a much greater limit than any other state. So I'm still wondering whether in a year or two, Mr. Modi can instill that kind of administrative bandwidth in all states. But I'll come to that state-center issue in just a minute. Let me just finish this budget part with you, Mr. Mehta. Let us assume for a moment that it is not going to be possible arithmetically to make 2 and 2 add to 6. Because there is a problem of 1,30,000 crores of fiscal or food subsidy, which the BJP itself in its manifesto has adhered to, has in fact asked for more when the parliamentary debates were going on. It stands to reason that in a potential drought year, you can't hike fertilizer prices and you can't increase the tax buoyancy, not in a year. But, Mr. Mehta, is it possible that something, a non-zero-sum game can be achieved if the stuck projects can be, restarted? There are a lot of projects that are stuck at the state level. Is it possible that simply because you have better diplomacy and you've been a successful chief minister, that part can be declogged?
Yeah, I think this is the point I was going to raise earlier, and it's not necessarily just related to the budget. And the point is that there are huge avoidable costs that were incurred by the previous government and which can be actually removed through very simple, in a way, administrative, non-legislative initiatives. You don't need to go to Parliament to actually pluck these low-hanging fruits. And certainly one of them would be to unclog the 2,000-odd projects that have been stranded because of lack of environmental or some approval. Now, it's not going to be as if between now and the budget date you're going to unclog all of that. But the very fact that you take the initiative to start to unclog some would be, again, a boost to confidence. It's very important that, for instance, we start to revive coal mining. I mean, the fact that there are power plants that are stranded because of lack of domestic fuel availability in a country that has the 5th largest deposits of coal is completely, it's wrong. It's very important that we begin to somehow catalyze the exports of iron ore. We were exporting $10 billion.
That's the court, sir. Yeah.
No, I'm just saying that
the Supreme Court which bans mining.
But there are, okay, let me take a different example of a low-hanging fruit then. Today, the recovery rate of oil and gas from existing producing fields, like Bombay High, Mumbai High, is 28% on average. And this is not my number, this is a number that the government of India has actually set out. The average recovery rate of fields of comparable geology is 40%. You don't need anything more than to deploy off-the-shelf technology to improve the recovery of existing discovered oil and gas molecules from 28% to 40%. And that would add billions, Now, it's not, again, something that's going to happen in 2 weeks' time or 4 weeks' time.
Sure,
but the very fact that if the Prime Minister was to call the chairman of ONGC or the chairman of Coal India and say that these are the targets you need to achieve in 1 year's time, and I assure you that I will safeguard you from the overzealousness of vigilance commissioners, the CBI or the CVC, I think it's going to send out a signal that would be exceedingly
starting
important.
the process of setting up independent regulators. I mean, the coal regulator is something that we've been talking about. The road regulator was promised in the interim budget. So just starting the process of even setting up independent regulators.
I'm looking at decisions that can be taken by the administrator literally not overnight, but within days.
Whereas if you were to start
to take decisions that required a consensus, like the GST. Now, we all know that GST needs to be implemented.
It's not happening till 2016 at least. Absolutely.
That's not happening in 45 days.
No, exactly.
It happens in 45 months.
All I'm trying to say to you is that there are some decisions that if the Prime Minister got up and made a speech and actually said a few of these things, This is what is required to actually revive the animal spirits, and that is what's going to be important.
Maybe we'll get clues in the joint session of Parliament, which the President is going to address on the 2nd of June, and that really lays out the mandate of the next government. So maybe we'll get clues on what this government intends to do.
Electrifying question.
Yes.
Okay. I just want to know if that will electrify the investment atmosphere. If somehow the gas price imbroglio is cracked, whatever, $7, 7.7, something less than the previous government, but it is cracked, and the word retrospective is removed and the same tax law becomes prospective, does that completely change the investment plane, Arundhati?
I think it does. I think definitely it does, because the worst thing that can happen for investment is uncertainty. You cannot have uncertainty, and the second thing is you cannot change the rules of the game while the game is on.
Yeah.
You have to be very clear about the rules. The rules can be as tough as you want to make them, but they have to be on the table before the start of the game. Once the game is started, you should not be changing the rules. And if that is made very clear that yes, these rules are the rules and they are here to stay, even if they are tough rules, people will play by it. So I think this uncertainty and this retrospective effect are very bad.
Yeah, in the finance bill, everybody's spoken ad nauseum about how bad the retrospective tax has been. But do you expect a clarification in the finance bill on the retrospective tax amendment?
Frankly, it's not that I expect it, but I think, it is warranted. Because unless that comes, it is very difficult to change sentiment on that front.
We were talking about FDI, and Madhu, you were talking about it. If that signal is there in the budget, that there is some sort of a clarification as far as the retrospective tax amendment is concerned, what is it going to mean for flows?
I think I'll be slightly more direct than what the ma'am was. I think that is the least expectation that the market is having, because otherwise, and they have spoken about it. So I think that is something, in my opinion, will be done, and that will remove. Again, the most important thing is the feel-good was missing in India, and that will get in a lot of feel-good. And it's not that people don't want to do business in India. India is and in the contest against Shadeen, what is important today is India is trading at a 40% premium to other emerging markets. But there is a reason, because everywhere else there is no opportunity which exists like this. There is no enthusiasm, there is no positivity which those markets are even reflecting. And there is no expectation of this kind of positivity.
Okay.
So I think a lot of money can flow in, provided they instill that confidence over the next 2-3 months.
Aditya, you think that tax law correction will make a big difference?
Yeah, no, I think it's a start. I think getting comfort with regulations and regulatory processes, I think, is a process. So quite honestly, I think FII investors can come in and exit the next day if things change.
Yeah.
FDI cannot. So I think just one signal is quite honestly not enough. It's a necessary start. It's a good start, but I think it's going to take a little bit more time. I think the tax issues and other regulatory issues with India have not been only the retrospective act. The act. I think there's been a larger dimension to it. So I think it's a process. It's a necessary and a good start, but it is a start. It is not the end of the process.
I added gas to the duo of decisions I'm putting before the table, because the arbitration is already underway, or at least been threatened, and it's kind of a decision that was announced with effect from April 1st. So, Mr. Mehta, do you think that if in some fashion that is resolved, that will make a big difference? And I want Arundhati also to speak on that, because a lot of power projects are stuck. A lot of money is stuck in anticipation of gas. So, first you, Mr. Mehta, will that be an electrifying announcement?
No,
is that the least you are expecting?
I think I don't think it'll electrify, because it's almost inevitable. So I think the market is expecting that to happen. The public will expect it to happen, because it was already decided upon through a very sensible process of evaluation by the Rangarajan committee, and it got politicized in the last few months, and therefore got kind of...
Some decision has to come. It can't be at 4.5.
No, exactly. It can't be. And by the way, one thing that people maybe don't know is that Mr. Modi actually ran a state where every segment of the oil and gas value chain was present. So his own company, GSPL, has a gas discovery in the Krishna-Godavari basin. And his discovery cannot be monetized at $8 even, probably. It's a very expensive discovery. And it's a deep water, high temperature, and I haven't looked at any of the numbers, But I can guarantee to you, I'll put a bet that there's no way that you can commercialize that discovery at $4, and I'd be actually asking the question whether it can be even commercialized at $8.
They've actually asked for a higher price, by the way.
But let me just finish this thought, because the fact of the matter is that today India is importing gas at $14 a million BTU, and we are crying ourselves hoarse to pay $8. Okay, so I don't think it will electrify the market. It is going to happen. It has to happen.
But do you think they're going to start the process all over again? Because the BJP has also said that they would like to review the decision that was taken. Do you believe that we're going to go all the way back to the drawing board? There's going to be another committee now that's going to be set up in place of the Rangarajan committee to oversee the entire process.
I may be proved wrong in days, but I would say that because Mr. Modi, not anyone else, actually understands the economics of oil and gas as well as any person in the industry, because he's in his state, he's got an exploration and production company, he has a refinery, the largest refinery hub in the world, he has built the only statewide gas grid in India, gas pipeline grid. He has power plants. It's the only state where the State Electricity Board, or one of two states, is actually showing a positive balance sheet.
Right.
So I think that Mr. Modi will somehow or the other finesse this particular issue so as to avoid another protracted committee and actually go ahead and agree to the recommendations of the Rangarajan committee.
Let me add now to Lata's electrifying question. Let me start with asking you, Aditya, and this is the question that everybody wants to know. Is the big sprint done as far as the markets are concerned? Do you see the markets consolidating? Have I picked up from your report?
Hey, you're cheating there. Yeah. That's from our report. No, my sense is I think the big sprint in the market is done, but I do believe the market has legs and it will sustain decent performance over an extended period of time. It's just not going to be, I'd be surprised if it were to be 20% in almost 20 days the way it's almost been. But I do believe the market has legs, but it's unlikely to be as sharp as it's been in the more recent past.
So what are you going to be betting on at this point in time? Which are the sectors that you're going to be betting on at this point?
The sectors that we like are really the banks, the energy space where we expect a certain amount of reform, cement, and this is slightly controversial, but IT services. No one likes it these days. Stocks have fallen 5% today, but
you always have some
nobody loved India. Nobody loved India 8 months back, and today everyone loves it. So.
Yeah, fair enough. Madhu, same question.
I think the whole complexion of the market, in my opinion, will change. So let me just dissect the question. Today we are at 25,000 index. So the index which run really, really hard, 25,000. The index which run really, really hard, which was IT, which is FMCG, which is the defensives. That index is still at 47,000. I did my math today. So the other index by definition is at 16,000. So I think there is that distinction is already there, that this index was at 13,000 just 2 months back. So the old economy favorites, sectors which are actually linked to economy and actually have underperformed significantly in the last 4 or 5 years, they will do really well. So while the index per se, I may agree with Aditya, may not run 20%, but I will not be very surprised that within that 20%, the complexion of the market changes and something goes of 100%. And with due respect, I think there is a humongous amount of over-ownership in defensive stocks. Because people's mindset has been this, that you conserve capital, be risk averse, because that is what the environment was.
So and you expect a sell-off?
Yeah,
I expect. 47,000 come down
that
to
sell-off, the trailer has only begun today. I think so, because the ownership of these stocks in these industries is so heavy. You see, in last 4 years, foreigners have put 450,000 crores. You do the math yourself. How much money has come into these defensive stocks and sectors?
I'm instructed that the audience is aching to ask questions, but I'll just finish this argument with Arundhati. You know companies from a very different angle. Which sectors do you think are looking like turning around first?
Well, definitely infrastructure. Infrastructure is definitely looking good. Textiles are also looking good. They were looking very good. Now with the appreciation of the rupee, maybe a little less, but still because the traditional markets are all performing well, I would say textiles are looking good. Thereafter, I would probably begin to look at whether metals and mining, which at least in some sectors are opening up. Karnataka has opened up. Goa looks to be about to open up. So some amount of metals and mining over there, and thereafter maybe the engineering and the other manufacturing sectors.
I was expecting you to say banks as well, because that's what everybody else seems to be betting on.
I don't comment on banks. I don't comment on banks.
You let everybody else do the talking on that.
Others, yeah.
Okay, so can we have microphones? If you can raise your hands, ladies and gentlemen, we'll get microphones across to you.
Just a request, you will have to keep your interactions to questions, and preferably a sentence so that we can accommodate everyone.
Yes. Can you give the gentleman here a mic, please, quickly? And if you can get a mic there. Yes, sir. Go ahead.
Hi. My question is to the panelist is in terms of, as you said, that the capital...
excuse me, can you please stand up, just mention your name and then...
Yeah, I'm Satyen Jadeja from Ananta. My question to the panelist is that you mentioned that the capital-led growth, you will have issues in terms of banking availability of funds. What do the panel thinks about agriculture-led growth or services-led growth? Or should we go on output and see consumption-led growth?
Anyone
started, I guess?
Yeah, go ahead.
Well, very short. I mean, I think the key point to recognize is, in a way, we've missed the industrial revolution, right? If you look at GDP, manufacturing today is 17% of GDP. I know sentiment, there's been a lot of talk about sentiment, but there are actual constraints on the ground. If you look at the ease of doing business that the World Bank puts out, we used to be 116th on that list a few years ago. We're now 133rd. So I think the focus has to be to move large parts of labor to the more organized manufacturing sector, which have got much higher productivity growth. If we become too much an agroeconomy, too much a services economy, we will miss that critical mass of manufacturing that all emerging markets have to go through. That has to be the focus, I think.
Yeah. Yes, sir. Go ahead.
Hello. My name is M.K. Ray from Lakshmi Diamond Industries. I'm in the diamond trade. Presently what I am seeing for the last couple of months is that there is too much of stringent policies adopted by ECGC, Export Guarantee Corporation, which is not in line with the Reserve Bank of India extant policy for gold card status holder exporters. Why there cannot be any, symmetry in between these two organizations so that the diamond can grow? ECGC, as you all know, gives the whole turnover guarantee to the bankers.
Unfortunately, we don't have anybody from either the government, the Reserve Bank of India, so I don't know if anyone here is...
Madam is there, she is expert in that. I would expect that she would intervene in the matter and help solve the problem.
Got it. Thank you, sir.
No, I understand your pain, but the fact of the matter is, like any other insurance company, ECGC is basically insuring certain exposures. And as you know very well, in the recent past, the gold and jewelry trade, including diamond traders, the risk has increased in a quantum manner. On the basis of the fact that, first of all, the gold imports, they have been restricted, and therefore, as you restrict a certain item from coming in, the turnover starts getting impacted, and therefore, there have been big defaults in this area. On the back of the defaults, ECGC has automatically tightened its ability to give further coverage, and therefore this is based on basically the recent experience. Now, as and when the experience starts getting better, I'm sure ECGC will look at it again, but in the immediate future, I don't really see any possibility of this particular tightening getting reversed. That is my own feeling at this point of time. It's not as though the banks are not represented, because we ultimately end up bearing the risk. But I don't think it's going to happen very shortly.
All right. Go ahead, sir.
My name is Lakshman Sundar. I define Modi as marvelous, outstanding, dedicated Indian.
Is there a question there, sir?
Do you think he deserves Bharat Ratna for liberating India, for prolonged misrule?
Well, actually, we have to speak about the road ahead, sir. This is way too ahead.
Maybe the Bharat Ratna will be part of the road ahead plan, sir.
He has got a number of problems, beginning with I.
We have that. We have that, sir. We have the problems that he's faced with. All right. If anyone... Yeah, go ahead.
Well, my name is Ajit Mathur. The previous government has handed over a messed house. Now, we all know infrastructure is the need of the hour. It is stagnated in Mumbai itself for over 4 years. Now, what do you see is the prospect of revival of infrastructure, reforms, particularly in India and more so in Mumbai. There were all the funds which were coming in infrastructure have been held up. And the state government as well as central relation is very important for further development. How do you foresee this process will start?
All right.
And how soon?
Yeah. Okay. Thank you, sir. Any volunteers? Yes.
Maybe I'll try and attempt that. I think, infrastructure has obviously been a big issue, not just in it not rolling out, but the risk it's put onto the rest of the system. I would say from an optimistic perspective, you must recognize that there has been quite an effort put in by the government over the last 18 months. So some of that is taking time, but I think it will bear fruit. I think the second point, which has been repeated, there is more capital in the system. Equity valuations are higher. There will be more money in the system, both to lessen the pain that is sitting on the system and to provide the capital, hopefully, of actually building out further along the line. The third thing is, I think, the first time anything goes out in an aggressive manner, there are mistakes by the government in terms of the policy framework they make. And there have actually been quite a few mistakes by participants who overbid and got their calculations all wrong. So I think that is also actually tending to improve, both from the government's perspective and from investors and operators in this whole space. So I would actually tend to be quite optimistic. If infrastructure stock performances are any indication, that would suggest everything is turning around. I'd probably be a little bit wary on that. But I suspect you've probably reached the bottom on that. It's the question of how rapidly they manage to grow up ahead. In terms of your specific question on Mumbai, as a long-term resident, I think the fact that you've seen a monorail this year, that next week I think you'll see a metro, and the fact that you've seen an Eastern Expressway come through, I suspect you need to be a little bit more optimistic in perspective.
And the SCLR.
And the SCLR.
Yes, very quickly, Sajid.
I just wanted to add one. It is an important part of that question, that a lot of these stall projects at the center, anywhere between 70 to 75%, are actually constrained because of issues at the local and state level.
Yeah.
So we focus a lot on the central level. Half of it is land acquisition, which essentially is a state subject.
Right.
25% has to do with pricing of power, which goes back to electricity board. So a lot of this will have to be a partnership between the central government and many, many state governments to fix before, we sit here and we assume all problems stem from Delhi. They don't.
Short point, it's a long draw.
It's a long draw.
Yes, go ahead.
One very quick further point. I think a lot of the promoters of infrastructure projects are now unable to actually finance the continuation of those projects. These are projects that are stuck, but the promoters are bankrupt. Their debt equity has gone from maybe 1 to 3 to 3. They're now to 3 to 1 debt to equity. So it's going to be difficult for them to actually run ahead with these projects, even if they get cleared. So maybe the government has to look at somehow recapitalizing, and I'm just looking at Mr. Bhattacharya, whether she agrees with me, recapitalizing some of the banks in order to actually trigger further infrastructure investment, because it's not going to happen through some of the companies that promoted these infrastructure projects in the last few years.
Yes.